Thanks for clicking. Canadians are increasingly growing less satisfied with their mortgages now that interest rates are rising. This according to a new survey released by CMHC.
It's money well spent.
Indeed, it's hardly going to come as a surprise that homeowners are growing more and more unsatisfied with their mortgages now that the cost of holding a mortgage has risen to its highest level in nearly 20 years. But the survey also found that Canadians are relatively dissatisfied with the entire home buying process in general, revealing a relatively downbeat sentiment about the home buying process compared to that of previous years. Yet the release from CMHC comes as some are noting that the real estate market is shifting back into high gear. So what I want to do today is go over the report, take a look at some key takeaways on how Canada started its spring real estate market, take a look at the report's findings in the context of a resurgent market, and then discuss what to look for next. Speaking of next, the Canadian Real Estate Association, the CREA, is expected to release the national sales data any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into CMHC's report. On the report, CMHC surveyed 4,000 mortgage consumers in between January 9th and January 30th of this year. There were two criteria in order for respondents to be eligible for the survey. One, they had to have undergone a mortgage transaction in the past 18 months, meaning they either bought a new home, refinanced, or renewed a current mortgage. And two, respondents had to be the primary decision maker in the household. And of those 4,000 mortgage consumers that responded to the CMHC survey, we saw a general downbeat in attitudes towards home ownership and the home buying process in general, with those who think the value of their home would increase in the next 12 months dropping from 84% in 2022 to 55% at the time of this survey. Further, while homeowners think that the value of their home will stagnate at best, they are also growing increasingly less comfortable with the amount of debt that they are holding, with only 66% being comfortable with their current debt levels, down from 84% in 2022. And that makes sense. When it doesn't cost you anything to hold debt, as it did in late 2021, early 2022, you're going to be much more comfortable with holding it.
Things are good, and it's going to stay that way.
But with interest rates up, with the cost of living increasing, CMHC found that only 78% of respondents, 78% of mortgage consumers who took out a mortgage in the past 18 months were confident that they would be able to make their mortgage payments going forward. Only 78% of respondents think they'll be able to make their mortgage payments in the future. That's down from 90% in 2022 and even down from 87% in 2019. That's a fairly substantial increase from even 2019 in the number of respondents who think they may have trouble making their mortgage payments in the future. 22% of respondents aren't sure they'll be able to make their payments.
Hey, buy yourself a new suit.
And the sharp drop of these attitudes towards the home buying process, towards home ownership, not to mention the drop in homeowners who think they got a mortgage that suited their needs, and the drop in those who think home ownership is a good investment, shows that when this survey was taken a year ago, when the survey was taken at the beginning of 2022 before the Bank of Canada raised rates and these attitudes turned largely negative, that there was a real lack of appreciation on the part of home buyers and maybe homeowners for what impact these rate hikes would have on the real estate market, would have on their finances.
I did everything I could.
Regardless, the concern over mortgage affordability and rising costs fall well in line with a report from RBC that we talked about in another video, which said that although mortgage delinquencies are down for now, the report was expecting them to increase by 1/3 over the next year. It's also well in line with another report showing that delinquencies have risen to their highest level since 2019. And while mortgage delinquencies are indeed still low, the survey from CMHC found that 74% of respondents had been negatively impacted or thought they would be negatively impacted by the interest rate hikes that we've seen, and 49% of that 74% were having difficulties making their other payments. Why can't the report just give us the number that we want? How many are having trouble paying their bills? CMHC contacted 4,014 people who got mortgages in the past 18 months. Out of those, 74% or 2,970 have been or will be impacted by higher rates. 49% of those, or 1,455, are having trouble making their debt payments, and as such, 36% of those who obtained a mortgage in the past 18 months from January are having trouble meeting their debt obligations. That's probably why we had to do the calculations ourselves. 36% of those who obtained a mortgage over the past 18 months wouldn't make a great headline going across Bloomberg if Bloomberg reported on the survey. Regardless, according to the survey, 36% of those who took out mortgages in the past 18 months, homebuyers, those who renewed their mortgage or those who refinanced their mortgage, are having difficulties making their payments. And, says the report, the worsening economy, this trouble with making payments, is leading to a more negative view of mortgage brokers and mortgage lenders, with borrower satisfaction with their mortgage broker dropping from 86% in 2022 to 71% in 2023, and borrower satisfaction with their mortgage lender dropping from 88% in 2022 down to 75% in 2023. So, CMHC is saying that higher interest rates, a worsening economy, a tougher financial situation is leading to a decrease in satisfaction with the mortgage buying process. That's probably it. But I think the key takeaway coming from this report, coming from a lot of reports, is the increasing level of strain being felt by homeowners, especially those that took out mortgages in the past 18 months. Despite the multiple reports that we're seeing calling for an end to the real estate correction, and amid predictions that the market is going to move significantly higher once again, the data from CMHC, the data from RBC, not to mention the delinquency and insolvency data that we see coming out, not to mention the 425 basis points in rate hikes that are still working their way through the system, shows that the picture may not be so simple. The rising prices in the real estate market are widely being attributed to a lack of listings. And a lot of this data coming out from CMHC, from RBC, from the insolvency data, show that we might be seeing more listings coming to market sooner than we think. If the economy does fall into a recession, if homeowners are unable to make their payments, if they're not able to withstand another year of this stress, which the Bank of Canada has warned us that we could be in for until the end of 2024, if homeowners are not able to continue to withstand the stress, then we could see more anticipatory selling, maybe even forced selling. Granted, we have talked before on this channel about the banks bailing out holders of variable rate mortgages with very explicit government support. However, it's not clear as of yet that the banks will be able to hold all of these assets on their books, all of these 35, 40, 45-year amortizations on their books ad infinitum. They can only kick the can down the road for so long and for so far. And evidence is mounting of stresses growing both in the real estate market and in the economy as a whole. With that said, we'll continue to have updates out on Canada's real estate market, on its economy, on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.